Most passive income advice online makes one quiet mistake. It treats very different things as if they're the same. As if dropshipping, dividend investing, YouTube, and crypto all belong in one neat bucket called passive income. They don't. Some of these ideas only pay you while you're actively working. The moment you stop, the income stops. Others continue generating money, even if you walk away completely. And mixing those two up is how people end up burning years of effort on something that never delivers real freedom. So instead of selling you another idea, this video does something more useful. We're going to rank the most common passive income sources based on how passive they truly are, how hard they are to build, and what actually happens when life gets in the way. Because the difference between freedom and frustration often comes down to choosing the right tier before you invest your time and money. Before we start ranking anything, we need clear rules, because most confusion around passive income doesn't come from bad intentions. It comes from bad definitions. People argue about strategies without agreeing on what they're actually measuring. So for this breakdown, we're judging every income source using two simple axes. The first is how passive it really is. Think of this as what I call the coma test. If you disappeared for 6 months, no emails, no updates, no work, would this income keep showing up? Or would it quietly collapse while you're gone? If the income survives without you, it scores high. If it depends on constant attention, it scores low, no matter how attractive the screenshots look. The second axis is barrier to entry. That's the combination of capital, skill, time, and stress required to earn the first real dollar. Some ideas are easy to start but painful to maintain. Others are hard to build but effortless to hold once they're in place. Most people fail because they choose strategies that don't match where they are in life. Or worse, they mistake a demanding job for an investment. This framework isn't about shaming any method. It's about placing each one where it actually belongs. Because once the definitions are clear, the ranking becomes obvious. And at the very bottom of that ranking is a category most people chase first, even though it almost always delivers the opposite of freedom. We start at the bottom for a reason. Because before you can build real passive income, you have to eliminate the ideas that quietly waste the most time. This tier is what I call fake passive income. These are strategies that sound effortless on the surface, but fail the coma test almost immediately. If you stop working, the income stops, sometimes within days. A common example is dropshipping. The pitch is familiar. No inventory, no shipping, no warehouse. Just set up a store, run ads, and collect the difference. On paper, it looks like an asset. In practice, it behaves like high-stress retail. Revenue looks impressive. Profit rarely is. Once you factor in advertising costs, payment fees, returns, platform rules, and competition selling the exact same product, margins shrink fast. And the moment you stop managing ads or testing creatives, sales dry up. That's not passive income. That's a job with unstable pay. The psychological trap here is the low barrier illusion. Because it's easy to start, everyone starts. Competition explodes, attention costs rise, and you end up fighting a daily battle just to stay even. Another F-tier category is speculative set-and-forget yield schemes, especially ones promising unusually high returns. These often pay rewards in tokens that lose value as fast as they're created. You may receive more units, but those units are worth less over time. That's not income, it's dilution disguised as yield. The problem with F-tier strategies isn't just risk. It's that they consume attention. You're checking dashboards, managing problems, reacting to changes. The income isn't buying freedom. It's demanding constant presence. If you want to run a business, that's fine. But calling this passive creates the wrong expectation. And wrong expectations are expensive. Once you clear these ideas out of the way, you can move into strategies that are genuinely passive, but come with a different kind of limitation. C tier is where things start to get more honest. These income sources do pass the coma test. If you disappear, the money usually keeps coming. But the problem isn't effort, it's scale and reliability. A common example is peer-to-peer lending. On paper, it looks elegant. You lend money, collect interest, and let platforms automate the process. In calm economic periods, returns can look decent, but the risk hides in the cycle. When the economy slows, defaults rise. And unlike banks, you don't have insurance protecting your capital. What looks like stable income in good times can shrink quickly when conditions change. You're taking meaningful risk for returns that often don't justify it. Another C-tier category is high-yield savings accounts and cashback stacking. This is some of the safest passive income available. It requires no effort, no monitoring, and no stress. But it's important to call it what it is. This isn't income designed to build freedom. It's infrastructure. High-yield savings protect purchasing power. Cashback reduces expenses. Both are useful, but neither can realistically support a long-term lifestyle on their own. The mistake people make with C-tier strategies is overestimating their role. They're not engines. They're shock absorbers. They smooth volatility. They reduce risk. They give you stability. But if you rely on them to create independence, you'll stall. C-tier is helpful, but it's not the destination. To actually build wealth, you have to move into strategies that can scale. And that's where most people make another mistake, confusing businesses with investments. B-tier is where most real money gets made, and where most people get confused. These are strategies that can build serious income and long-term value. But they only work if you're honest about what you're signing up for. Because these aren't passive investments. They're businesses. A clear example is content-based income like YouTube channels, niche blogs, or media platforms. Once content is published, it can keep generating income long after the work is done. That's real leverage. A video or article can act like a digital employee, working in the background while you focus on something else. But getting there takes time, skill, and consistency. You're learning production, storytelling, analytics, and audience psychology. In the early stages, you might work for months, sometimes years, without meaningful income. That's not passive. That's front-loaded effort. The same applies to things like print-on-demand or niche digital products. The asset can scale beautifully, but only if you continuously protect it. Algorithms change. Competition copies. Platforms shift rules. If you walk away completely, income usually fades. B-tier passes a partial coma test. If you stop for a short period, income may continue. If you disappear long enough, momentum breaks. That doesn't make these strategies bad. It just means they're often misclassified. The real danger is treating a B-tier business like a passive investment. When people expect effort-free returns from something that requires ongoing attention, burnout follows. Used correctly, B-tier is incredibly valuable. It's often the engine that generates surplus cash, the money that eventually gets converted into truly passive assets. Which brings us to the next tier. This is where capital starts working harder than effort. A-tier is where passive income starts to feel real. These are assets that can generate meaningful wealth over time. They pass the coma test partially, but only if they're built and managed correctly. The most familiar example here is direct real estate. Rental property is often called the holy grail of middle-class wealth, and for good reason. It combines several powerful forces at once: rental income, long-term appreciation, debt paydown, and tax advantages. But it's important to be honest about the trade-off. Real estate is not a set-and-forget asset. It's a service business. Even with a property manager, you're still the decision-maker. You approve repairs, you manage risk, you handle vacancies and financing decisions. On paper, the cash flow can look attractive. In reality, that income is often uneven. One major repair can wipe out months, sometimes years of profit. A-tier assets work best when you have capital reserves, patience, and a long time horizon. They reward discipline, not shortcuts. Another A-tier category is high-quality digital products. Things like courses, tools, templates, or software built around real demand. Once created, these assets can scale extremely well. Selling 10 units or 10,000 units requires almost the same effort. That's powerful, but the barrier to entry is skill. The product has to be genuinely useful, and even then, distribution, trust, and customer support don't disappear entirely. A-tier assets sit in an uncomfortable middle ground. They can generate real income, but only if you accept the friction. They're not effortless. They're worth it. But the most passive assets, the ones that demand the least attention over decades, live one tier higher. S tier is where passive income actually earns its name. These are the only assets that pass the coma test completely. If you stop paying attention for months or even years, they don't collapse. In many cases, they quietly perform better when left alone. The clearest example is broad market and dividend ETFs. When you buy a diversified fund, you're not managing products, customers, or employees. You're supplying capital. Thousands of companies go to work on your behalf, reinvesting profits and paying distributions over time. There's no daily decision-making, no optimization, no constant monitoring. That's the advantage. The trade-off is obvious. To generate meaningful income, you need a lot of capital. A 3% yield doesn't feel exciting when you're starting out, but once the base is large enough, the stability becomes hard to beat. Another S-tier asset is REITs, or real estate investment trusts. They offer exposure to real estate, apartments, warehouses, data centers, without the operational burden. You receive rental income as dividends, but you're not answering calls, approving repairs, or managing tenants. REITs aren't risk-free. They respond to interest rates and economic cycles, but from an effort perspective, they're about as passive as it gets. Here's the key insight. S-tier assets aren't impressive in screenshots. They don't move fast. They don't promise shortcuts. But they do one thing extremely well. They let time do the work. Which leads to the final question. If S-tier is the goal, how do you realistically get there without falling for the wrong strategies along the way? Here's where everything connects. Most people fail with passive income because they try to jump straight to the end. They see S-tier assets and want the outcome without the process. When the capital isn't there yet, they get frustrated, and that frustration pushes them toward F-tier shortcuts. That's the trap. In reality, passive income works best as a pipeline. Early on, you usually have more energy than capital. That's when B-tier makes sense. You build skills. You start something active. You accept that effort comes first. But the key difference is what you do with the income. Instead of upgrading lifestyle, the surplus gets funneled into S-tier assets. Broad market funds, dividend strategies, long-term holdings that don't ask for your time. Over time, the balance shifts. Less effort, more capital, more stability. Whenever you evaluate a new opportunity, two questions cut through the noise. First, what's the bottleneck? Time or money? If it needs your time, it's a job or a business. Treat it honestly. Second, what happens if you stop? If income disappears immediately, it's not passive. If it fades slowly, it's semi-passive. If it keeps going, you've built something real. The goal isn't to avoid work forever. It's to move your effort into places that compound and eventually remove the pressure to trade time for survival. True passive income isn't about chasing side hustles. It's about building systems that let capital carry more weight than effort year after year. That's what turns income into freedom.